Morning, guys. It's Thursday, August 7th, 5:25 a.m. Central Time. Grain markets mostly higher this morning. Nice change of pace. December corn futures up 2.5 cents at 403 and 3/4. November soybeans down a half at 984. December Chicago wheat up 4.5 cents at 533 and 3/4. December Kansas City wheat up 6 at 538. December spring wheat up 2.5 at 594 and 3/4. A little bit of action and some of it positive in the corn market yesterday. Why don't we start there?
So the December 25 corn futures contract fell below $4 per bushel for the first time on Wednesday. Widespread rainfall and favorable weather across the majority of the Corn Belt have boosted yield expectations and put downward pressure on prices. Private groups continue to publish large U.S. yield estimates. The average trade guess ahead of next Tuesday's report is 184.2 bushels per acre versus USDA's most recent print of 181 bushels per acre. Expectations of a record Brazilian corn crop have also weighed on futures.
All right, I'm looking at the average trade guesses for Tuesday's report, and most of the groups surveyed. So the way Reuters does this, they actually ask them two questions. They say, "What do you think USDA is going to say?" And then they ask them, "What do you think actually the final yield is?" I think that most people kind of look at the what is USDA going to say, and most people believe, most of the groups believe that USDA is going to print at 185, and you've got a couple outliers that are at 181 and 182. StoneX is the high number at 188.1. We talked about that estimate early in the week. So the trade is thoroughly convinced that USDA comes up with the yield number on Tuesday. I am not, I don't have any reason to believe otherwise. The action in the corn market was positive yesterday. So there were large volumes traded below $4. Call it a stop run. The title of the video is going to be Stop Hammer Time. We ran some stops and then it was hammer time, right? So that's at what we call a hammer candle on the chart, and it looks like a hammer, right? It's got a handle and then it's got a head. It looks like a hammer. So it's not really a reversal pattern, but what it is the market shrugging off new lows and saying, wait a minute, maybe we got too cheap there for a second. And the fact that it was done on large trading volume is a positive. It's very premature to call this a low, but it would make sense if it was a low because big lows or big highs in the market almost always occur on large trading volume. One other thing to note here is that you've got a ton of carry in this SEP to D's corn spread. We're at 72% of full carry at 22 cents. Full carry would be like just past 30 cents. Very rarely did these spreads go past 75 or 80% of full carry. Some people believe that some of the selling yesterday was farmer selling, farmer puking, if you want to call it that, of remaining old crop bushels, which would make some sense given the action in the spreads. But this is a positive move. And big picture, you step back. Okay, now we're only 70 cents below production cost instead of like 78 cents below production cost. I mean, it still sucks. We're still in dire straits here, certainly, but maybe just a glimmer of hope. And we hope that we can find some follow through buying here today.
Wheat futures posted fresh lows yesterday. The September 25 SRW contract fell to 504 per bushel, the lowest level for a spot contract since May. The contract was able to recover slightly, ending the day a quarter of a cent higher at roughly 509 per bushel. Abundant global stockpiles and weak export demand continue to weigh on prices. Soybeans also extended losses, with the November 25 contract falling about 6 cents to settle near 985 per bushel. The decline followed weakness in soybean meal futures, which have been dragged down by sluggish demand and ample supply.
Let's look at a wheat chart. So the Reuters headline said we were at 5-year lows. It's not really a 5-year low, not the way I read it. If you look at an SRW wheat chart monthly continuation, your post-COVID low was 493.5, which was posted sometime during the middle of last year. So you're getting close, but you're not there yet. And we hope, I mean, wheat sucks and the market's been terrible, but we hope that we can at least hold above those post-COVID lows. The wheat situation in globally speaking is not super bearish relative to previous years. In fact, USDA is projecting that it's going to be the tightest since, I believe, the 2014, 2015 marketing year. So, I mean, it's a fairly tight global situation, relatively speaking. I mean, the 32% stocks to use ratio is still burdensome, but we're always burdensome in wheat, I guess, for the most part. The U.S. situation is a different story. USDA is projecting a stocks to use ratio for the United States at 44.3%, which would be the highest since the 1920 marketing year. So I guess the fact that we're getting close to pre-COVID lows. Somewhat makes sense based on the U.S. numbers alone. Feels awfully cheap to me, though. Here's soybeans. You're approaching some key chart support. This area, 982 is a big trend line, and we kind of flirted with it yesterday and then bounced. And then 971 was your low in April. So we hope that that support area can hold. I wanted to mention the heat real quick. The forecast has become even warmer today. Based on GFS ensemble data, our friends at Crop Profit estimate that U.S. soybean areas will run 4.3 degrees above normal on average over the next 7 days and 5.5 degrees above normal on average during the 8 to 14-day period. I discussed the heat yesterday and how maybe it can be a double-edged sword. Some people said the heat's bad no matter how you slice it. Some people said we need the heat. It was kind of a mixed bag of responses. But in any case, the market, especially the soybean market, does not seem concerned at all about the current and forthcoming heat situation.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Did Brian call it yesterday? I hope he did. I mean, we hope that this is right. I'm not going to say yet that we've reversed higher, but we did post a new low and then ended the day closer to unchanged. I think we were still lower on the day, but it was a good looking bar yesterday. And if we can find some follow through today, maybe we did post a short term bout. Brian does an excellent job with charts. A lot of times to cut through the noise, and admittedly, I'm part of the noise half the time. To cut through some of the noise, you need to look at the technical side of this, and Brian is the best in the business. Does an excellent job. He ran through corn, soybeans, wheat, a whole bunch of other stuff yesterday. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. It's information only. We just want to send you our content. We produce tons of content every single day. Mackenzie, we do 10 shows a week, and 5 of them are on YouTube and on the podcast. But the other 5, the real valuable stuff, is part of the premium subscription. And that is the content that's geared toward the farm decision maker. If you're doing the marketing, if you're doing the crop insurance, if you're doing the tax planning or retirement planning or any of that stuff, this is where you'll find the information that will help you to make decisions. Sign up this morning, guys. There's no other fee, no other obligation. You can cancel at any time. Give that deal a shot.
A new COVID-19 variant known as XFG is spreading across the US and worldwide. It was first detected in Southeast Asia in January and has steadily spread worldwide and has now been confirmed in 38 countries. As of late June, XFG accounted for 14% of COVID-19 cases here in the US, making it the 3rd most common strain. Current data suggests XFG causes symptoms similar to other variants and is not believed to be more contagious or severe. At this time, authorities have not identified any major public health concerns associated with the variant.
This is probably nothing, right?
I hope.
I don't think that this country will do lockdowns ever again the way that they did in 2020. I just don't think the people, generally speaking, are going to go for that following the 2020 debacle. And different people, of course, have differing opinions on that. COVID, just as a refresher, we figured we'd throw this in today because maybe it does turn into something. I don't think it will. But COVID ruined a lot of stuff. COVID ruined the crude oil chart among a million other financial charts because we traded negative, which is something that you've never seen before. It really just wreaked havoc on financial markets around the world. I mean, this was a global lockdown that occurred when COVID happened in 2020. And it really it changed everything. I mean, it changed everything. You look at the inflation we've seen since, the way that prices of everything have adjusted since, the incredible amount of money that the government created in the name of COVID. It was absolutely insane. And I feel like almost all analysis associated with markets, you've got to like almost break up between like pre-COVID and post-COVID timing because it changed everything. And we hope that it doesn't change everything again. But if the government needs to print more money, they're going to need an excuse. And maybe that's where they find one. I don't know.
Mosaic shares tumbled on Wednesday amid tariff pressure and declining fertilizer sales. The company reported weaker than expected second quarter results, causing shares to decline by more than 13%. Mosaic's profits have been weighed down by reduced phosphate and potash sales, along with extended maintenance delays. U.S. tariffs have contributed to a 20% year-to-date decline in phosphate and potash imports, pushing domestic prices higher and weakening demand. Additionally, declining crop prices have reduced farmers' fertilizer budgets. The company expects global phosphate shortages to persist into 2026, helping to support a stronger fertilizer market in the years ahead.
Mosaic stock has fallen off a little bit. I sent a note to our friend Josh Linville, who is a fertilizer celebrity at StoneX, and he sent me this as a comment on this article. He said, phosphate values are expected to stay very high as long as Chinese exports remain half of what they normally are. 5 countries around the world control nearly 90% of production and exports, with China's 2025 quota at only 4.5 million versus the normal 8 to 10. There simply are not alternatives. U.S. values remain even more bullish, high priced due to tariffs blocking most import lanes and low production rates limiting domestic supplies. Demand destruction is expected to weigh on applied tons this fall, next spring, but right now it is not likely large enough to influence values lower. Potash's short-term outlook continues to appear stable. However, the longer-term view is that supplies are solid versus demand, which should continue to cap price ideas. With expanded production coming from Russia, Laos, the U.S., and Canada, that supply outlook improves, which should further limit high price ideas. So I think, long story short, based on what Josh wrote here, prices are going to stay high, but maybe not a whole hell of a lot higher, which is not necessarily great news for the farmer, given that what I talked about earlier, we're so far below production cost in all of these crops. And a lot of that, especially with regard to corn, has to do with all of it, has to do with super high input prices. And this is just one piece of that.
U.S. ethanol production declined last week. Weekly output of 1.08 million barrels per day was down 1.4% on the week, but up 1.3% versus the same week last year. Ethanol stocks also declined, falling to 23.76 million barrels. The print was down 3.9% compared to the previous week and down marginally compared to the same week last year. According to Reuters data, U.S. ethanol production margins further strengthened over the last week.
Yep, pretty solid here. We're toward the upper end of anything that we've seen during the last 10 years. Here's another chart that COVID kind of ruined. I mean, that big down bar in 2020 was pretty nasty. Ethanol stocks are still too high. There have been ideas that there are exporters just sitting on stocks that are waiting to be exported. One thing that should be noted when it comes to ethanol production, just because you're producing more ethanol doesn't necessarily mean you're producing or you're using more corn. We've improved efficiency pretty drastically. Today, 1 bushel of corn yields like 3 gallons or a little bit more of ethanol. That number was like 2.95 years ago. It was 2.8 in 2015. So the efficiency has improved, which is not necessarily the best thing for corn demand, I suppose. What did cattle do yesterday?
Cattle futures continued their historic run yesterday, setting new all-time highs once again. Live cattle were $155 to $265 higher. Feeders saw gains ranging from $360 up to $487. Box beef prices also climbed higher. Choice was up $492 at $374.86, and Select was up an impressive $542 at $351.60.
Dow Jones is up 260. The S&P is up 42. Treasuries are mixed. U.S. dollar is about flat. Crude oil is up 50 cents, and the September WTI at 64.85. Have a great day, guys. We'll be back on Friday.